Good afternoon, everybody. Thank you very much for joining us on this lovely sunny day. It's Robert Dixon here, who I look after UK sales for Han ETF. And today I'm joined by Jay Plosky from TBW Investment Management of New York, and Anthony Ginsberg from Gins Global, California. And we're going to be looking at investing in the sort of post-COVID-19 world. Obviously, the world and markets are sort of reshaping in a very fast fashion. Markets are polarizing. It'd be great to hear Jay's thoughts on that, and also Anthony's perspective on the sort of winning tech trends and themes that are in place, and where we have solutions in partnership with Anthony. So at this juncture, I'll pass over to Jay, and I'd just like to say Q&A will be held at the end of both presentations. We have Jay conducting the first half with his sort of macro outlook and how to play the asset classes, and then Anthony on thematic solutions, and then we'll take questions and answers thereafter. So over to Jay.
Thank you, Rob, and good afternoon and good morning from New York City here, where I'm happy to say we have kind of seen the worst and passed through the worst of COVID-19, and now hopefully on the upswing, much as financial markets are. I'd like to go ahead and take the next probably 15 or 20 minutes to walk you through our second half outlook, which we titled The Great Reopening and published last Friday. And great to be with Han and Anthony of Gins Global to talk about the outlook, because as Rob mentioned, things are moving at a very fast pace. So our focus at TPW Investment Management is global macro multi-asset, leveraging ETF-based risk-aware portfolios. We really have a focus on simplifying the global macro marketplace, making the complex simple, and we do that, as the slide shows, in three ways. We have a tripolar world view, which is a thesis I've developed over the last decade plus, basically argues that regional integration in the three main regions of Asia, Europe, and the Americas is the next step for globalization. And of course, we all know what's happened with globalization over the last several years. More recently, at the beginning of this year, we added two drivers to our thesis. They were technology, which we call splinternet. We are believers that the tech divide between the U.S. and China, with Europe in the middle as the regulatory referee, is going to be a lasting issue. And then we also added climate, which we believe clearly is not being solved on a global basis, with the U.S. pulling out of Paris, the Paris Accord, but nor can it be dealt with individually. So again, a regional driver is the push on climate in dealing with the climate uncertainties. And more recently, just obviously in the last 4 or 5 months, COVID-19 has also, in our view, been very much a driver towards regional integration, and we'll talk more about that. We then use our global risk nexus scoring system, which looks at economics, politics, policy, and markets across those three regions. And here we've added a fifth column or factor, the health factor. And we're going to explore that in some detail. And then we have obviously the plethora of ETFs to choose from, not only country or asset or region, but also increasingly factor and segment. And Anthony's got a great lineup to talk about some of the key areas in the second half of the presentation. So investing during what we call the Great Reopening is, I think, obviously the challenge in front of us, and it's a challenge that has fast-moving, highly volatile markets. We think that speed is the signature of COVID-19. First of all, the speed of the spread, then the speed of the policy response, absolutely unprecedented. Then the market reaction to both of those things, equally unprecedented both on the collapse and on the rebound. And we think there is another factor where speed is going to come into play here in the second half, and that is the science response. The science and technology community dealing with COVID-19, again, global, 100% focus, unprecedented, and we think it's going to be dangerous to not factor in the likelihood of a faster than expected scientific response to the virus. And we're also now starting to think and invest on the thesis that the move to reflation and inflation is going to happen faster than many expect. So as I said, we believe you have to get the health piece right, especially during the reopening. So we added a piece to our Global Risk Nexus outlook. And then I think it's worth thinking about this last point, that the one area where COVID-19 has not upended things is in the leadership of U.S. tech-led equity markets as well as the U.S. dollar. So something that we're spending a lot of time thinking about. So here we're going to go through our risk nexus first with health. Obviously, we've kind of gotten to the point now globally where we flattened the curve, we've preserved health systems for the most part, and we're in the reopening phase. To us, what's important here is that we are learning animals, and we have the benefit of the fact that the virus has spread first in Asia, then to Europe, then to the United States. So policymakers, corporate executives, individuals have the ability to understand what happened in the regions in front of them and how to take what they have learned and implemented and use it ourselves. And so I use as the example the auto manufacturers. Reopened first in China, now been open for almost a month, reopened in Europe over the last 2 weeks, using the techniques and the strategies to provide a safe reopening process for their workers in the production process. And now in the United States, just this week, auto plants are starting to reopen again, using the same techniques and strategies learned from their operations in Asia, refined in their operations in Europe, being implemented much more quickly and aggressively and immediately in their reopening in the United States. I think this is a very important thing to keep in mind. The second thing that I think is very, very important is the importance of testing and tracing to allow for reopenings and to allow, in particular, people, consumers, to feel comfortable going out and consuming. We're all part of developed economies, which are 70% plus consumption driven, and therefore the ability to feel safe and comfortable going out and consuming is going to be critical to the success of the reopening process. And we'll talk more about that. And then the last point, to reiterate that we don't want to underestimate the speed of the scientific response. Monday's stock market action in the U.S. gave a very good illustration of the danger of fighting two fronts, fighting the Fed and the global liquidity and fighting science. A couple of charts here, just to look very quickly. The one on the left showing how far out of the kind of consensus or the line of activity and infection the United States is. So the U.S. is reopening up here versus all of the other countries down here. Thus, the U.S. needs to be able to test and trace in a very meaningful way. My concern is that the U.S. reopening is risky because the test and trace regimes, particularly across the country, are not anywhere close to what they need to be. These testing numbers are now up here, 450, maybe approaching 500,000. We need 500,000 to 750,000 a day to feel comfortable that we have the testing capacity. We're not close in the United States to having the tracing capacity necessary. And so the U.S., while third in line and able to benefit from the reopenings in Asia and Europe, is the most risky reopening, in my opinion, because of the lack of testing and tracing. So moving to the next step in our risk nexus, economics. The thing that people have really struggled with, I believe, is the gap between horrible current economic data and rising risk asset prices, particularly equity rising prices. And to me, it is, again, a function of how fast things are moving and the forward-looking nature of financial markets versus the backward-looking nature of data. And this has been shown through any number of data points over the last month or so. I expect that to continue. The market has already priced in the current and future, near future economic data, and takes comfort that the policy response has been sufficient to fill the gap. And we'll see a nice chart on that in a minute. Next question is, will the recovery be a U, a W, V? My point would be that only 15% expect a V. A lot of upside if we come out with anything like a V. Last point, stimulus, sowing the seed for reflation. That's a key issue, as I mentioned earlier. Liquidity, supply chain disruption, demand. Once people feel comfortable, all of a sudden you're going to go from zero demand to 60 to 70% of normal demand. Okay, not 100, but remember, we're starting from zero, effectively. And so there could be some demand pull inflation. So I think we're going to move quickly from disinflation to reflation to inflation. That is a regime change I believe investors need to be very focused on. A couple of charts here. Obviously, the liquidity chart on the left, pretty stellar provision of liquidity. And on the right, a pretty interesting Bank of America chart suggesting that we are coming out of a decade of disinflation and heading into a decade of inflation. We're just kind of at the cusp here. I am a big believer that this is going to be moving up in the next couple of years. Okay, there we go. Tried to move it, didn't happen. So politics is next. We talked about how COVID-19 is deepening regional integration, shrinkage of supply chains, cross-border tourism and trade reopening in a regional kind of trade bubble or tourism bubble, whether it's New Zealand and Australia or China and South Korea. The reopening is going to be gradual and it's going to be regional first. The new fight, obviously, over vaccines, that's been all over the press. The question is the kind of the state of U.S.-China relations going forward. I expect plenty of U.S.-led heated rhetoric. President Trump, as we'll see and discuss in a minute, needs to have an enemy, particularly to kind of deflect attention away from what has been a less than stellar federal response to the virus. But neither side wants to take any more economic weakness risk. And I think that's an important point. Rhetoric, yes. Action, meaningful action that can affect either side's economy, I don't expect that. Third point, big government is back, U.S. in particular. If there is a Democrat in the White House next year, and even more so if there's a sweep of the House, the Senate, and the presidency, there could be significant systemic changes made in the U.S., particularly around tax policy and around tech and the risk of antitrust activity starting to bubble up in conversation in the United States. Here's a couple of charts showing what I mean. The chart on the left is the predicted for Trump versus effectively Biden. You can see how these numbers have changed in the last couple of weeks, the last couple of months. Pretty considerable, not good news for the president. And over here, the outcome of that, U.S. opinion of China, it has gotten very unfavorable. So there's been a drumbeat in the last couple of years on how China is a bad actor, and that has now manifested in public opinion. And I think if you probably put a Trump voter or a Republican here, rather than just overall, it would probably be up in the 90%. This helps explain why we're going to see a lot more rhetoric, heated rhetoric, coming out of the United States. So policy, coming up next. The bad news is a lack of global coordination. The good news is that there has been a declaration of war, the rolling thunder of individual country action on both fiscal and monetary policy. One of the reasons why we should expect inflation is because for the first time in many years, going back several decades, we have both fiscal and monetary policy on full throttle pretty much around the world. It is an environment that many have not invested in, and is something that's going to be different as we go forward. I do expect in the second half to see continued policy response. China's two sessions Congress is this weekend. We'll get action there. The European Joint Recovery Plan, been a lot of headlines about that. That will continue to play out going forward. And in the U.S., Phase 4, the House has already approved a $3 trillion bill. It was a negotiating stance, but there is going to be a Phase 4 in the United States. We are in an election year. No one is going to say no to more spending unless there is truly a V. So as an investor, you either get a V or you get more policy stimulus, which has the same effect effectively on risk assets. As we said before, speed and the science would be a positive surprise. There's a nice picture of how the policy support fills in the gap between the leading economic indicator and the S&P. Picture tells 1,000 words. Second half outlook. From record-breaking to broken and back in record time, there's been really a requirement for mental gymnastics at the Olympic level, I would say. We remain constructive on risk assets. The risk is centered around failed reopenings, U.S. politics, U.S.-China tensions. And it's important to note we've had reopenings now around the world, and so far there have been clusters, yes. Limited outbreaks, yes, but no need to shut down nations. Again, that is very supportive for being constructive. 6 pillars of support: global policy, zero rates, which helps explain multiple expansion in the equity space; economic bottoms, we already have bottomed in the global economy; gradual reopenings without massive outbreaks; bearish and underweight investors. Investors are being pulled in to risk assets, and the upside of potential scientific advance. We believe sell in May and go away will be a mistake. We are dip buyers. We believe the global equity market bottom is in. Fed and other policymakers have short-circuited the traditional retest. So for us, there are two big questions. One we mentioned: can COVID-19 overturn U.S. equity leadership? Does the chaotic U.S. response put the premium valuation at risk? Will bear market recessions lead to equity leadership changes? And then the second big question is, will Reflation 2020, which was the title of our Outlook piece in December, make a return from the dead? We think increasingly both of these questions will be answered in the affirmative. So to quickly run through a few slides and then turn it over to Anthony, here's a slide on investor sentiment. Remains bearish, as you can see. Markets are discounting a short recession. Good charts to spend a little bit of time studying. I don't want to spend too much time because I want to make sure Anthony has his opportunity. But in our view, markets are discounting a short recession. The recession is going to be Q1 and Q2. We're going to be pulling out of it in Q3 and Q4. Makes perfect sense for equity markets to be discounting and moving up ahead of the bottom in the recession. Credit already clearly ahead of where it would typically be. You do have the recession and bear markets typically resetting the clock away from growth to value, away from defensives to cyclicals, away from the U.S. to non-U.S. value markets like Japan, like Europe. We expect that to happen in the second half of the year. Here, as we've seen, tech drives U.S., obviously. Cyclicals drive Europe and Japan. The chart on the left, I think, very, very telling. Very interesting to see it laid out this nicely. I think this is a JP Morgan chart. You see on the right consensus for 2021 earnings. Look at the cyclicals. That is not, markets are not going to wait until 2021 to start discounting that type of earnings growth. That is going to happen, and in my view, is already starting to happen, and the last week was very illustrative of this. The action on Tuesday, Wednesday, very negative, 5% pullback. What was bought on Thursday, Friday, and Monday? Cyclicals, small caps, financials, energy, miners. Big question here, is it time to buy EM? We're not big EM buyers. We're very focused on China and Asia. First in, first out. There is a sign that those first in countries are starting to lead and outperform even the United States. So we're Asian focused. We're China focused. We like tech in the emerging space. We are worried about Brazil and Turkey in particular. Pay attention to China. So as we said, plenty of dry powder. Expect action here in the next couple of weeks. Major beneficiary of the oil price collapse, driving domestic demand. Obviously the risk of heated U.S. action beyond just rhetoric, which again, we do not expect. So our positioning, I'm just going to talk about where we are now, not what we did. We are currently overweight equity, underweight fixed income, particularly sovereign. We're neutral commodities with a bias to add, and we have a sub 5% cash position. We're running in tech, value cyclical kind of barbell. Mentioned some of the areas we liked before. In fixed income, we are focused on credit. We like U.S. high yield, preferreds, tips, emerging market dollar debt. Very bullish gold and gold miners, adding to base metals. Simple chart showing how effectively Chair Powell stabilized credit without spending a dollar. Very impressive. Look at that issuance, off the charts issuance. Huge demand, by the way, for yield. The search for yield has not disappeared. It's only grown ever more. Oil, the shock really affected commodities. The third shoe dropped when oil went negative some weeks ago. Commodities are the only sector not to really have any rebound, still basically down 35 to 40% year to date. Very bullish on gold and gold miners, have migrated from simple gold to gold miners to gold junior miners. And I would also highlight, if you go back and look over a 10-year chart, typically gold miners lead the other base metal miners. That's already starting to play out, and we have built positions there as well. That chart just discusses what I just mentioned. We're going to finish on the dollar and turn it over to Anthony. I think I've maybe run over a few minutes, so I apologize. But a big question tied to, will COVID-19 overturn the U.S. equity leadership? Will it also affect the U.S. dollar? We think it's likely. Look at the explosion of Fed excess reserves. Look at the history of what that typically means for the dollar. And the last point I would note was that since March, a weaker dollar, and it hasn't been very weak, but it hasn't been strong, but days when it's weak, risk assets tend to do better. I'll stop there, Rob, and turn it over to you or Anthony. Thank you.
Hey, thanks very much, Jay. That was very illuminating, and thanks for your thoughts. Anthony, I take it you're online now, and would you want to take over the presentation?
Sure. Thank you, Rob, and thank you, Jay. It's exciting to join you folks and to talk about the technology space. Obviously, what we've seen with COVID-19 has been an acceleration and a fast tracking of adoption rates across various forms of technology. So I'm going to go through the fourth industrial revolution and the different components, and then how it impacts three particular ETFs we have with the Hand-Gins ETF range covering, you can see on the screen there, a broader ETF called Innovative Technologies. It covers all the major mega trends in tech, and then we have a specific cloud technology ETF with about 50 holdings, and also a healthcare innovation / medical innovation ETF, and that has close to 100 holdings. So I'll get to those in a few moments. I'm just going to go through the slides briefly with you. Just to explain where we are today, obviously the first industrial revolution related to mechanization back in the 19th century. Then we went on to the second industrial revolution at the turn of the 20th century with mass production, particularly automobiles and factory production. And then obviously in the late 60s, the computerization is the very early stages of automated production. And now, of course, the fourth industrial revolution. If you have a careful look at that, it's covering everything from social media to future cars to 3D printing, healthcare innovation, AI, robotics, as well as cloud computing. So that's what I want to take you through the next couple of slides, and also look forward to doing a Q&A with you subsequently. One of the key things, and Jay actually alluded to it, because of COVID-19, obviously, as the lockdown persists, many of the new work from home behaviors, we believe, are going to become increasingly permanent fixtures. Also, supply chains have been impacted, and as labor costs, obviously have risen, the use of robotics has grown increasingly popular. Now, you've seen it in certain countries globally where there was an aging population, whether it's Japan or South Korea. So if you look at this particular chart, some of the data comes from The Economist. You'll see the biggest users of robotics historically were parts of Asia. So you've got South Korea, Singapore, Japan there. But the forecast is basically for a doubling, essentially, in robotic use. A lot of it comes in the automotive space, but it's becoming more and more prevalent. Even the likes of Amazon and others are utilizing it. So it's just an example of what we've seen historically in robotics, but it's actually had a fast tracking recently in the healthcare space as well, where you've got robots being used in ICU or hospital units for cleansing materials, and also for AI diagnostics in terms of actually not having to touch patients physically. So the whole space is, in many ways, people believe, because of COVID-19, the future is being brought closer to us, and a lot of things are basically being fast-tracked. Areas that may have taken some years to adapt, such as telemedicine, telehealth, you may have heard of. The vast majority of medical systems and healthcare systems were not using and had not embraced telehealth in a major way. Obviously, all of that has changed over the last 3 months. So we don't believe that these behaviors are going to change and go back to the old ways. I think we're in for a new normal, and that's partly why you've seen the technology space recover very speedily. Not all tech holdings, but across the swath of what we're involved in, particularly the Industrial Revolution 4.0, those underlyings have performed remarkably well. Actually, all three of our ETFs are positive for the year currently. So I'm going to just move on and just explain to you our broadest product, which covers the fourth industrial revolution. We call it the Innovative Technology ETF, covers all these sub-themes as you see in the table. This table goes from 2015 across to the end of April 2020. And for year to date, it's obviously, you can see that the performance of the themes can vary significantly year on year. This year to date, healthcare and biotech have been stellar performers as people search for vaccines. And as we talked about, medical wearables, telehealth has helped provide a real booster rocket behind that theme, and obviously has helped our healthcare ETF in a dramatic sense. our broadest 4.0 product, iTech, you can see how it's performed over this period of time. Essentially, it equally weights all these sub-themes. And it's rather difficult to time the sub-themes perfectly. So the idea here is that over a period of time, we feel it's a very broad and safe way to go after Industrial Revolution 4.0, because you're covering cloud, you're covering future cars. I mean, just to touch on future cars for a moment, everybody is aware that Tesla is about to, within the next couple of months, probably join the S&P 500. The market value is now over 150 billion. That's almost 3 times the size of Ford and GM combined in terms of market cap. So increasingly, we view Tesla actually in future cars as technology companies, essentially being able to sell proprietary battery and also automotive technology to other car makers. So increasingly, we see Tesla actually being valued mostly as a tech company rather than as an automobile player. So I'm just going to go through a few more slides just to give you an idea also of the cloud space. Obviously, cloud has got a model called it's a subscription model. It's a rather easy and flexible model to transition to. So over the last couple of months, there's been a huge spike in the usage of cloud technology. This slide shows over the last year, as well as going forward, that up to 60% of all IT expenditure is predicted to be in the cloud space. It currently is the big tech battleground, almost our modern day battle of Hastings, if you like, where big tech is really fighting it out. And the way we've divided our cloud ETF in the cloud space up is through these 4 subcategories. One is infrastructure as a service. That's the bottom part. Those are really the plumbing and the pipes that have been built out by the likes of Amazon or AWS, which currently accounts for more than half of Amazon's entire profitability. This is Amazon Web Services. It makes actually a lot more money than Amazon Prime does. Then you move up to the platform as a service, which relates to the likes of Google and also Microsoft Azure, which have software platforms that are fairly flexible for people to work from home and to use these existing platforms, whether it's Office 365 or Windows, for example, or the various Google software available. And then software as a service are obviously video conferencing facilities and other players that have particular software that's feeding on top of the cloud infrastructure. So you can see the growth predicted over the next couple of years. Gartner and other leading researchers believe that the 60% IT expenditure focused just on cloud will not be harmed much by COVID-19. In fact, there's been an increase in movement away from hardware and on-site IT premises by both large and small and medium enterprises over the last 3 months. So the hit has really been for on-site hardware, which have seen a drop-off in expenditure, but cloud has actually picked up fairly healthily. And we've obviously seen some of the underlying cloud players, including Amazon, hitting new highs. So we're happy to go through that. Just an interesting aside to that is that the VPNs, virtual private networks, which is part of the whole cloud and cybersecurity space, have also shown a dramatic drive up in demand just in the last couple of months, given the work from home phenomenon. So I'll move on to the next slide, which really shows the size of cloud revenues relative to robotics. And our sense is that in Europe, there have been investors going into the robotics area. Up until recently, cloud did not have individualized products available that were UCITS or domiciled in Europe. We believe that's changing, and there's increasingly demand for cloud-focused ETFs and related products. Interestingly, the cloud revenues are expected to actually grow, given what's happened with COVID-19, or expected to grow at a similar rate to robotics, but off a much higher base. And that just gives you a summary, really, of the development of cloud, where you've got the infrastructure as a service at the bottom, as the base of the pyramid. Then you've got platform as a service built upon that. And then just to summarize, the area of software as a service, which will over time become larger we believe, than the other two areas. So software as a service, or SaaS as they call it, includes everybody from SAP to Salesforce to the likes of Oracle as well. And given that cloud is increasingly inexpensive and being embraced by small and medium enterprises, we actually see CRM software and the likes of SAP software, Oracle, being embraced by small and medium enterprises increasingly. And the delivery mechanism is much, much cheaper than it was historically, where many of those programs or materials were restricted to larger corporations, largely due to the delivery system. But it's changing in a major way, and it's become a lot less expensive. I wanted to just touch on healthcare and the space, because we've seen a dramatic increase in usage there, not just across medical wearables and telehealth, but also the area of AI in healthcare. And that relates to everything from diagnostics on the left-hand side to virtual assistants or chatbots. Also areas such as precision medicine and gene therapies, or genomics as it's often called. The idea is that genomics or gene therapies are expected to double in size. A number of the companies that are at the forefront in the biotech space and with vaccines research for COVID-19 come out of the genetics area. Interestingly, one of our very largest holdings in our healthcare ETF, Regeneron, is one of the leading 3 or 4 that is in the race to find a vaccine. So obviously, just across the board in healthcare, including mobile apps, scheduling apps, and the medical wearable space too, has seen a huge pickup in demand. We don't believe that behavior will revert. And we actually have also seen a big pickup in expenditure. People, both governments and private hospitals, embracing the use of cloud and AI to really push forward this remote working by their doctors and consultants. So the NHS in the UK is actually at the forefront of that as well. And this just summarizes on this slide the growth, the compound annual growth rate expected in the medical wearable space, covering such things as sleep trackers, activity or fitness monitors, and diabetes monitoring as well, with blood sugar levels. The compound annual growth rate is expected to basically grow as much as 40% annually over the next 5 to 6 years. So it's a significant growth rate. It's also becoming increasingly mainstream. We recently saw Fitbit being acquired for $2.5 billion by Google, even though Fitbit at the time was not making significant profit. The interesting part is that Tim Cook, the CEO of Apple, is also saying that his legacy will be in the healthcare space. There's also moves by Amazon and a couple of the other big tech players to really hone into healthcare and into wearables. Many of us in the financial world thought big tech might look into banking and financial services, but the truth is that they're spending a lot more time and energy and acquisition power in the healthcare area, including healthcare data management. Of course, in the US, it's a disparate healthcare system. If you get sick in California and you're from the state of New York, it can be tricky to actually ensure that the client's details are easily shared. So there's a huge opportunity to share patient data, and also for diagnostic purposes and for medical wearables, as big tech helps upgrade this area. I would say up to a decade ago, healthcare was rather a sleepy hollow for technology, and that's all changed. And frankly, it's been fast-tracked in a dramatic way with the coronavirus too. A lot more energy is being expended now in the healthcare tech space. And with that, I just wanted to move across to, just to summarize, the cybersecurity area. This is another part of the Industrial Revolution 4.0. Cybersecurity, many know, has obviously grown as you come out of hack attacks that we had some years ago in Hollywood with the North Koreans hacking so many pictures. So has the adoption rate and the outsourcing rate by not just Hollywood studios, but many, many companies who said they are not in the business of technology. They don't want to continue to hire software engineers. So there's been a real groundswell to move towards the cloud, which really is a symbiotic relationship with cybersecurity. As the cloud takes off increasingly and becomes more and more mainstream, so has the expenditure in cybersecurity. I referred to the use of VPN or virtual private networks earlier on. That is all directly linked also to work from home and cloud expenditure. So the point really is that cloud offers pricing flexibility and easy transition for most small and medium enterprises. And we just increasingly expect more adoption rates, not just with cloud, but as that goes forward, cybersecurity really is sort of a brother to cloud. In fact, there are a number of cloud holdings in our ETF that also do play a role in the cyber security area. This is just really a final slide, Rob, before we take some questions. And it just shows, although Amazon has a leading share in the cloud infrastructure followed by Microsoft and Google, the important point here is that actually Google and Microsoft are actually growing at a faster clip. Obviously, with video conferencing, we're hearing about things like Google Meets has significant contracts across all the school systems, from the New York school system to the California public school system. We've got Microsoft Teams, which is also competing now with the likes of Zoom. So all in all, we actually see a lot of fast growth below Amazon, but Amazon had a head start on them, and that's why the chart still shows Amazon having a huge lead. I think the important part, though, is that the likes of IBM, which you see there as well, are moving into a space called hybrid cloud, where it allows multiple clouds to be used. So big firms and large banks, insurance groups, instead of outsourcing to a single cloud player as they would have done in the past, they can now, with open source software, which IBM are able to offer through their $35 billion acquisition of Red Hat 18 months ago, they can move the data more easily between public and private clouds or multiple third-party cloud providers. So the idea really, and it's been embraced by many of the Fortune 500, such as AT&T and others, to outsource to a number of cloud providers. And then, of course, we've also seen the Pentagon and public enterprises increasingly embrace the cloud too, with one of the largest $10 billion contract being awarded, surprisingly, not to Amazon, but to Microsoft some months ago. So with that, Rob, I think I'll turn it over to you, and I'm more than happy to take questions about the fourth industrial revolution and where we see it playing out post COVID-19. Thank you, folks, very much for tuning in.
Hey, thank you very much, Anthony, and thank you for Jay for that. Both very interesting outlooks on the way forward, and that's obviously a very important thing. Anthony, a question here, please, on the cloud space. There's been some quite, sort of respectable performance, outperformance, and polarization in relative sense performance from the cloud arena. And within that, the sort of more mids and smaller sort of service software as a service sector has performed quite acutely. Question is, are these companies overcooked right now in terms of the sort of investor hype and focus post the changes that we've experienced over the last few months? Because gains of 20s and 30s percent are quite material. Our valuation is a bit stretched, perhaps, with what we know right now.
Yeah, it's a fair point and a good question. Actually, we've been very careful in our cloud ETF to be very diversified across infrastructure, platform, and software as a service. There are one or two products out there that have been perhaps overexposed just to software, and obviously certain software companies, whether it's video conferencing or some of the FANGs, have obviously bounced dramatically. We actually have limited our FANG component to a 4% cap weighting, so it's rebalanced every 6 months in our ETF, and we call it SKY, S-K-Y-Y. Our cloud technology ETF has 50 holdings, of which it's pretty evenly spread across the board, Rob. So I think the point really is we've seen the software PE ratios being a little stretched. We've seen some of the FANGs being a bit stretched, but we're a lot broader than that. And I think folks have to really be careful and dig into the underlying construction of the index. We tried very hard to not be over represented by just some of the mega caps. So even firms like Microsoft, Amazon, and Google, in our case, they're limited to a 4% weighting. And I think the important part for us is that we still see platforms and infrastructure as a service as a key component as cloud is rolled out globally across developing and emerging markets. And in that area, a lot of the mid-cap and the small-cap players have not had valuation stretched to the limit. So we actually see, when we talk about 60% expenditure being projected by big tech in this space, we see a lot of acquisitions actually in the mid and small-cap tiers. And in fact, when IBM bought Red Hat, at the time, Red Hat was about the 15th largest holding that we had. Overnight, the share price doubled. So we actually see a lot more opportunity in the mid-cap and small-cap space, which is perhaps a little bit less covered, and those valuations haven't been stretched to the limit. So it's a fair question. At this point, I'd say some of the mega caps, and just to summarize, the software as a service space has been more fully stretched.
Hey, Rob, could I just jump in? It's Jay.
Please, Jay.
Yeah, no, I mean, I just Anthony's comments was super informative and very exciting. It's the first time we've done a webinar together. So really enjoyed your presentation, Anthony. And it struck me with what you were saying there at the end, that with the speed of things accelerating, driven in part by COVID-19, would you expect more kind of M&A activity by the bigger players into that small and mid-sized space because they're not going to have the time, the window to kind of build their own? I mean, it would seem to me that the more I think about the environment we're in, the more speed is really a defining factor. And I think it's going to be, clearly it's happening as I laid out. I think it's a signature issue, but I was just struck by your comments, and I wonder if you see that the speed of things accelerating means the big cap tech, which has, as we all know, tons of money, gobs of money, and not really being able to politically increase dividends, increase buybacks. Would you expect maybe a bigger M&A activity within the small and mid-cap space?
It's a great point, Jay. Actually, there's a twofold answer to it. One is actually the antitrust issue, which I didn't even touch on. The big boys are not able to make massive mega transactions occur under the current environment. So we actually see them being able to far easily complete small and mid-cap acquisitions on the one hand. The other issue is, yes, the speed to market. It is a land grab. I mean, the tech space for the last decade has been, a land grab, first to market. So it's actually a twofold issue. If they want to execute speedily and get the land grab, in their favor, they really most likely will pick up the mid-tier companies and some large caps that are below the mega size, because they just don't want to go through any antitrust or regulatory issues in DC. Right. So it's probably a twofold answer. Yes, so we definitely see a pickup. There's already a number of transactions that have occurred, even in the last 2.5 months, believe it or not, across cloud and also areas such as virtual reality, which we also cover in our iTech or Innovative Technology 4.0 ETF. So absolutely, they've got gobs of money, you're right, and they're not stopping anywhere. They've all realized that things have been leapfrogged essentially as a result of COVID. Yeah. So no one in that space is slowing down.
Yeah, it makes perfect sense. And I would just add that, the antitrust, for the folks who are in Europe, I don't know if they're aware that the Justice Department just announced that they intend to bring an antitrust action against Google. Now, antitrust is kind of like China bashing. It's fashionable across both sides of the political aisle in the United States, and so I think it's probably going to be accelerated if there is a Democratic administration, and even more so if there's a sweep by the Democrats, which I think is very much a possibility, much more so than it was 5 months ago. And so I think this idea of antitrust, and even there, just thinking about GINS Global and how you mentioned being diversified and being global is also kind of interesting vis-a-vis just having a specific tech focus. And I would just add that if you look at the market action in the last couple of days, the things that are moving are cyclicals and value. Tech, big cap tech is actually underperforms fairly significantly on the days when cyclicals and value start to perform. And so I think what you could see is a little bit of, in the big cap space in particular, where people have gone, the FANGs, which are up, 15, 20% year to date versus broad tech in the U.S. up 5%. You could see people use those positions as a cash and take some profits off and swing into the cyclical and value space. So it's very interesting to just kind of observe both the near-term market action and then link it up to this shift in adoption and speed in the technology space, which is, again, as I said, we are focused very much on a tech cyclical value barbell. So we want to be in both because we do see the technology being even ever more critical and therefore an area of opportunity for investors. But we also see, coming out of a very rapid recession, we see a big opportunity in the cyclical and value space.
Yeah, it's interesting, Jay, what you were talking about. Quickly, Robert mentioned that actually Monday was an interesting day because the NASDAQ, which is dominated by basically 8 to 9 of the FANGs and a few other big players, actually underperformed most of our ETFs, interestingly, on the big day on Monday. And it's largely because, as Jay was saying, it's already been fully priced in many ways, the FANGs. So I would just say to investors, they've got to be careful. They've got to look at the underlying composition. I mean, the NASDAQ is very top-heavy with literally 8 or 9 big holdings, which is primarily the FANGs, whereas we've been very careful in all our construction. I mean, the innovative tech ETF caps basically at 1.5% across almost 90 holdings for the fourth industrial revolution, and cloud, as we were saying earlier, has a 4% cap on the biggest cloud players. Sorry, I'll turn it over to you, Rob.
Well, question for Jay. In your presentation, you talked about time to buy EM equity. Obviously, you've also alluded to, cyclical assets, as we come out of a recessionary dip. And ordinarily, of course, you buy value first, and that's what you're sort of alluding to. Is it right to buy the generic EM exposure, with its state-owned enterprises, or are there more efficient ways? I think this is being levied because the last time you were here, Jay, of course, you did it in conjunction with another of our partners, that's Kevin Carter from EMQQ, who, of course, has a different take on EM investing, which has got an internet and e-commerce bias, so obviously a tech flavor within EM. So what do you think?
Yes, no, we like EMQQ, the idea of that very, very much. The way to get exposure to the fastest growing part of emerging markets, which is, again, the technology and the adoption of tech and internet and e-commerce, and the fact that you can get it globally. Again, much as with Anthony's work, if you're a global multi-asset investor, as we are, and you're trying to run a fairly concentrated portfolio, which again we are with the ETF model business, you don't want to have more than 15 or 20 holdings. And so something like an EMQQ or an iTech makes an awful lot of sense because you can get exposure to a lot in one instrument. And yeah, you're not going to make, the 100%, let's say, if because you're only going to have the 3 or 4% position in a company that maybe gets bought, but you're going to participate as an investor, and you're going to outperform your index. As Anthony mentioned, all of his vehicles are up year to date, whereas ACWI, the global equity index, is down 12% still. So that's massive outperformance. And so we are not fans of broad emerging market equity. As I mentioned, we think there are some big EM countries like Brazil, like Turkey, that have some real challenges in front of them. We do have a bias to Asia, first in, first out of COVID, dry powder policy-wise in China, beneficiaries of low oil prices. And so to us, and they're part of the tech cycle, right? We want to be part of the tech cycle in EM. So EMQQ is interesting, China is interesting, Taiwan, South Korea, et cetera. That space is where I think you want to be, because the traditional, and I'll stop here, the traditional way of thinking about EM, and I started in EM way back many, many years ago, was they would become offshore production platforms, which would allow them to go up the value-added curve and pay their people more and grow and develop consumption. That is being taken out by the exact stuff that Anthony's mentioning with robotics. In our own tripolar worldview, the ability to self-produce is the second driver in the regional deepening construct. And so that offshore production platform role for EM is being disintermediated. And so I think the idea of, well, EM's cheap relative to history, it's not convincing, which is why I put that chart up. It looks very attractive if you like to buy, stuff that's beaten down, and a lot of people make the case for EM. But we're in a world that low growth is going to be, notwithstanding a recovery from COVID-19, growth is going to be subpar relative to the last 20 or 30 years. So to think about EM, I think you need to think about it differently. I think you can think about it differently because of ETFs, one of the wonders of the vehicle, and then thinking about things like EMQQ or iTech or WELL. That's the area where I think people should focus.
Well, guys, I would like to thank you very much. We have no more questions at this juncture, so unless there are any last-minute additions, please do so in the next few seconds. Drop them into the box. I'd just like to point out to people that joined us this afternoon that you can get this resource via the attachments and links that are on the forum. So please do that. If it's not possible, then please don't hesitate to contact me at Han ETF. That's Robert Dixon. And I'd like to thank Anthony and Jay for joining us from the States. I hope you have a super week and rest of the week and weekend. And look forward to speaking with you guys next time. And I'd like to thank everyone for joining us this afternoon. So thank you.
Thanks, Rob.
Thank you, Rob. Thank you, Anthony. Thanks, everyone.
Thanks, Jay.